Hey guys, it's Sasha. The US economy contracted by 0.3% in Q1, the first negative quarter in 3 years. Given this quarter things are a lot worse, we might well already be in a recession, and we're just waiting for Q2 data to confirm it. The contraction in the US economy was much worse than analyst forecasts, and the media is now acting very surprised this morning. The S&P 500 is down 1.5% so far this morning because it turns out nobody expected this except, random guys on YouTube. And the thing is, the way the numbers stacked up in Q1 actually makes it a lot worse for the rest of this year. The data suggests that the chance now of a significant recession has increased significantly, because when you look at the detailed data, Q1 was extremely unusual. As everybody was expecting the tariffs to turn up at some point, you can see this chart that investment contributed plus 3.6% to the GDP growth, and imports then subtracted 4.8%. And it seems that all the media and all the commentary and social media basically go only about as far as this chart. A popular story here is that the only reason that Q1 GDP was negative is because companies imported so much stuff before the tariffs started. So actually, if you ignore that one-off effect, people importing so much stuff, then actually everything is great. The US economy is doing fine. Everything is dandy. That is the argument that I have seen a lot on social media. But unfortunately, it's bullshit. The numbers just don't agree. And let me break it down for you, because it's really important to understand what is actually happening with the US economy with all of these numbers. So the two lines that we need to dive deeper on are the investment line and the imports line. And this table is the detailed version of that chart that we just looked at. You can see on here that the gross domestic private investment contributed 3.6% to GDP. Remember, these numbers are not growth rates. They're not relative increases. They are the contributions to GDP in this particular month from these sectors, and that's not the same thing. And the vast majority of that came from this massive increase in non-farm private inventories. So this line is basically companies building up stocks of goods. This is companies importing a whole load of stuff from China and other countries before the tariffs hit. Not just goods for sale, but other things that they need to operate their businesses. Things like machinery, things like parts, components, fertilizer, whatever. So those companies had more stock now available before everything became a lot more expensive once the tariffs hit. So you can see that this is an abnormally high value. The only other time that this number skyrocketed was during the pandemic. But then just below, you can see that the net exports of goods and services is taking away 4.8% of GDP in the same data. And almost all of that is coming from the imports line, specifically imports of goods, which contributed minus 4.79% to this quarter's GDP read. And here's the thing. When companies build up inventory, it is counted as a positive contribution to GDP. So when that inventory is then drawn down next quarter and in Q3 and so on, what will happen is that the inventory will shrink and it will take away from the personal consumption line. It will essentially cancel a whole bunch of the personal consumption line. So the imports that decrease the GDP this year will now be sitting there as inventory items, and it will reduce the GDP in future quarters because it will basically cancel some of the GDP growth from inventories being run down. This front running of stockpiling goods means that there is now a much greater likelihood that in the next 2 quarters, GDP will be suppressed and could again be negative, which would then be a recession. Because when companies use up the inventory, it has a negative contribution to GDP. And then there is the huge amount of imports. You can see in the main table that the contribution to GDP from imports of goods was up 50% in Q1. That's an incredibly big number from companies trying to front run the tariffs. But eventually, those stockpiles are going to run out. Maybe instead of the usual 6 to 8 weeks, some companies now have 10 weeks of inventory. But when that starts running out, and it will, we are going to be talking about inflation again, because tariffs will be making a whole lot of things a lot more expensive. Well, everything except investing, because you can invest without paying any commission on eToro, who are the sponsors of today's video. If you want to invest in the S&P 500 or the global stock market index, you can go and invest in ETFs without paying any commission at all. eToro does not charge any commission on investing in ETFs, and if you invest in your local currency, wherever you live, whether that's pounds or euros, you don't have to pay any foreign exchange fees either. So you can open an eToro account, you can deposit your money, buy the S&P 500 ETF, and you will pay a grand sum of nothing in fees to do it. And on top of that, eToro has a massive investor community. There are people sharing their portfolios, a bunch of discussion, and even free courses. There's a reason why over 35 million people around the world use eToro already. Go and click that eToro link in the description or in the pinned comment and open an account and see what you think. A lot of people really like the eToro platform, so go and check it out. All right, so let me show you even more detail, which will explain why this GDP report is bad news. Total goods imports in Q1 were $996 billion. It's the sum of these 3 months. And that number is up 19% compared to Q4 and up 27% on Q1 last year. That's a massive increase. The biggest increases were from consumer goods, things like phones, TVs, and so on, which were $262 billion. That was imported in Q1, up 24% on the previous quarter, up 36% on the same quarter last year. And then industrial supplies and materials, $251 billion was imported, and that number is up 54%. And then capital goods, things like machinery for factories, was up 20% as well. So about 2/3 of the increase in imports in Q1 came from capital goods and industrial supplies. Only 1/3 came from companies stocking up on consumer goods. So places like big farms, industrial manufacturers stocked up on things like machinery ahead of the tariffs hitting, because a lot of that machinery is manufactured in China. But the stock of consumer goods did not go up anywhere near as much. And there is a good reason for that. Fertilizer this year is exactly the same as the fertilizer you bought last year and the year before and 10 years ago. But the latest iPhone or the latest laptop or graphics card or whatever might become outdated and obsolete later this year, maybe in a few months or even a few weeks. So naturally, you can't import many categories of goods for long periods in advance because things change. And there is the cash flow and production issue as well, where factories only produce so many of these things per month. So even if you wanted to buy a ton of them, there are only so many that you can actually import and front run. And companies that are buying within the United States only have so much spare cash that they are prepared to sink into building up those inventories as well, because there's a lot of risk assigned to it. So the important point here is the data suggests that there is a buildup in inventory, but it is mainly coming from non-consumer goods categories. So those will just be used up in the coming weeks and months and then be deducted from the inventory item in the GDP report, but not result in direct sales on the other side. And by mid to late May, stockpiles of consumer goods may begin running low, at which point retailers will be forced to resume imports with the tariffs, which immediately makes everything expensive, right? This will mean that they finally have to start pushing up prices. And this puts the Fed into an impossible situation. On the one hand, the Fed is watching the economy implode in a self-destruction mechanism. We have a negative GDP quarter, more downside looks like it's on the way. And on the other hand, we have now a very serious risk of inflation because of the tariffs. And the method of cure for these two things is the opposite. In order to stimulate the economy, you would want to reduce rates. But to try and get inflation down, you would want to increase rates. So you get into a bit of a pickle if you're Jerome Powell. Now, having said that, only one of these two things in the current scenario is something that the Fed actually can have some impact. There's only one thing that is an actual point of concern. The prices going up bit is a bad thing, but it's something the Fed will not really be able to solve for unless they are prepared to completely nuke the economy in the process. The only way that prices will not go up with these tariffs is if the Fed increases rates so much that nobody can actually afford to buy anything because everyone is in financial trouble. And I'm presuming that's not something that they want to do. In that scenario, companies will start on taking losses just to sell their products. Prices suddenly going up because of tariffs is nothing to do with inflationary price pressures. Normally prices are going up because the economy is too hot, and here we have the exact opposite. If anything, the Fed should probably consider reducing rates at some point if this situation continues deteriorating, because that could actually help try and get the economy going again, as opposed to just watching it collapse from the sidelines and doing absolutely nothing about it. Because reducing rates would stimulate spend as people get a lower return from holding on to their cash, and the cost of borrowing reduces. Now, predictably, Donald Trump had a meltdown on Truth Social the moment the GDP data came out. "This is Biden's stock market, not Trump's. I didn't take over until January 20th. Tariffs will soon start kicking in and companies are starting to move into the USA in record numbers." No data, but yeah, whatever. "Our country will boom and we have to get rid of the Biden overhang. This will take a while. Has nothing to do with tariffs. Only that he left us with bad numbers. But when the boom begins, it will be like no other. Be patient." So yeah, the fact that companies imported stock at unprecedented levels before the tariffs hit had absolutely nothing to do with tariffs. Of course, that makes perfect sense. Just so we're clear, the maths does not give a shit about political opinions, whichever side of the aisle you are. This implosion of the US economy is not only completely self-inflicted, but it's also 100% down to the actions of this administration. Companies are now panicking because they don't know what the tariff policy is going to be on any given day. It gives nobody any certainty. Nobody knows what they should be doing. Certainly nobody's going to be making massive investments in the hundreds of billions of dollars because this policy seems to change every single week. Consumers are panicking because they are afraid that prices will go up on things that they want to purchase, afraid that they might lose their job. Maybe the business that they are operating will collapse. And literally, all of this is because Donald Trump printed a bunch of made-up numbers on a large piece of cardboard and then announced a policy that nobody actually thought through for more than a minute. Nobody with a brain anyway. And then he made daily changes to the policy that he just announced for no reason without any kind of concessions from anybody. You can wait as long as you want, but the destruction of trust, the destruction of working relationships, the abysmal way that this whole thing is being treated will last a lot longer than Donald Trump will be in power. Other countries are not particularly happy about it. And I know that it might not seem like it, but that is a problem. I know there is a segment of die-hard Donald Trump fans who perhaps won't understand. They prefer these isolationist policies because nobody's actually learned any history. But in many countries around the world, basic courtesy, basic politeness, following the rules, sticking to agreements that you have made in the past is a very big deal. It's an incredibly important deal. Going around calling other people, other countries' names, making shit up, saying a whole load of baloney, being incredibly rude to the leaders of other countries does not go down well, especially in Asia. And the problem with burning bridges is that sometimes it takes a lot of time and a lot of effort to rebuild them. Remember, go and check out eTORO, the sponsor of this video. Thank you so much for watching, and I'll see you later.